Today, the XRT ETF jumping nearly 2.5%. Joining us now to break down the big move and to look ahead is JPMorgan's top-ranked retail analyst, Matthew Boss. Welcome to Overtime. It's great to have you on.
Thanks for having me, Scott.
You know, after Nike reported, I think the big concern became bloated inventories and shrinking margins in this environment. Overblown across the board, or should we really be worried going into earnings season and, just sort of where we are?
So twofold story. The bloated inventory and the inventory actions Nike needs to take is a result of the sector they operate in and the in-transit inventory. I think the much bigger takeout was doubled street revenues in the first quarter, spoke to no softening in demand in September, and they're actually talking about 20% constant currency revenue growth for this quarter, and that's all after doubling their expectation last quarter. So to me, the big takeaway out of Nike was if you have relevant inventory in the right category, the consumer is still there. And I would actually make the argument more than there if you're in a sector that has a total addressable market that's at least as great as before the pandemic.
Wow. So if you're one of the, haves rather than have-nots, demand trumps margins at the current time.
Yeah, because I think the issue that Nike has is this in-transit inventory that was tied to the supply chain issues that started with the pandemic in the footwear category. As Nike said it, look, we sell Air Force Ones. To get enough inventory over here in time, we would have had to enlist the entire U.S. Air Force, and it still might not have moved the needle. So I think these inventory issues are transitory. I think the top line is really the storyline that came out of Nike that has implications more across the sector.
No, that's a dangerous word to use, Matthew Boss. I'm sure you would agree with that, using the T word. Hasn't worked out well for some others. Who else has it then? Who else has what Nike has that can buck the trend?
Yeah, I think what you're really looking for is casual as the multi-year trend coming out of this on the brand side, meaning Lululemon, I think, is operating at a very high level. The handbag and accessories companies, Tapestry and Capri, also two names that I think are mispriced from a valuation perspective. But then I think secondarily, it's value and convenience. We had a piece out today talking about a survey. The low-income consumer is under the greatest amount of pressure, but that's why value and convenience becomes that much more important. So to me, it's dollar stores and off-pricers, Dollar General, Dollar Tree. That's where I think Five Below, as well as TJ Maxx, Burlington, and Ross stores, all opportunities for a consumer that's gravitating to value and looking for the most convenient opportunity. That's, I think, the other side of the playbook as we move to 2023.
So you're undoubtedly describing an environment in which specialty retail outperforms department stores.
Yeah, I think it's more value convenient, so off-pricers as well as dollar stores on the defense playbook. And by the way, this was the playbook that we've seen in periods of other consumer disruptions. But then I think there's opportunity now, given the dislocations from a valuation larger picture on discretionary, to pick up some of the top brands. And that's why I'm pointing out the Nikes of the world, the Tapestries and the Capris. I mean, these are trading 7 turns below pre-pandemic multiples for companies that I think across the board are the most scaled and have the most pricing power. And one of the other takeaways from our survey today on the consumer, they're unwilling to move away from the quality brands. So I think they're being more discerning with their dollars, but they will save and spend on the quality, best-in-class brands.